There were two articles of the many that you've written most recently that really grabbed my attention. One is titled, Central Banks Are Going Bust. We want to talk about that. You also wrote another one called, Is the Credit Bubble Bursting? Both of those sound fairly dramatic. The first one, to some viewers in the cheap seats, would seem like almost an oxymoron. They say, how can central banks possibly be going bust? Because they're tied at the hip with treasuries, and treasuries can always print more credit by just a stroke of a key. So therefore, they can never go bust. They could just create more credit out of thin air. And maybe that's tied to your second one about the credit bubble bursting, but we'll get there when we get there. But first of all, what do you mean by central banks are going bust, and how can we tell?
Well, if you look at it purely from the point of view of any trading entity, if your equity is wiped out by losses, mark-to-market losses, if you like, or even trading losses, then you are trading fraudulently, and indeed is a criminal offence in most countries to do so. But that is the position which all central banks are in today. Of course, as you imply, people don't worry about this terribly because they say, well, they can always print more currency. Well, that is obviously true. And it's been particularly true if you look at the situation of the Bank of Japan, whose equity is so far underwater. I mean, because the Bank of Japan owns roughly 60% of Japan's debt, the JGB market. This is enormous. And so the equity, last time I calculated, the figures are not that material, but it was something like 40,000 times underwater. The equity was so insignificant compared with the losses. The second thing people say is, well, there is always the other backstop, and that is that central banks are owned by governments. They're a government agency, and so they are backed by the, if you like, the tax revenues of government, ultimately. Now, that as an argument is pretty specious, because if you look at certainly the US, you look at most of the European countries, so we'll take it as the EU as a whole, the UK, and also Japan, these countries, these nations, these units are in debt traps. In other words, their economies are not growing sufficiently to pay down the debt, or if you like, to cover even the interest on the debt. Now, under those circumstances, this is called a debt trap. And inevitably what happens is that the lenders, if you like, the creditors, demand a higher interest rate in return for this extra risk. Now, this is particularly apposite at the moment, because if you look at the US economy, it's stalling. It is actually, on any sensible calculation, it is actually going backwards. The private sector is contracting. Now, the reason I get there is quite simple. And this is on official figures. The Congressional Budget Office's own figures say that the US economy is growing at 4.5% in this fiscal year. But the budget deficit is 6.5%. Take 6.5% away from 4.5%, and so you've got a private sector which is contracting by 2%. Now, that's in nominal terms. As well as that, but if you take the official rate of inflation expected by the CBO at 2.9%, you're looking at a contraction of 5%. Now, we can calculate it for this year. You can also do the same calculation for the previous year, and the year before that, and the year before that. And of course, the COVID year was a real economic disaster for the private sector. So I think what's happening is people are beginning to understand that this is the problem. So in effect, you've got a contracting private sector GDP, which is meant to support this increasing level of government debt, which in the US case is increasing by roughly $2 trillion a year. So where is the revenue, if you like, to back all this? The revenue isn't there. So you've got, on the one hand, you've got the revenue diminishing. You've got that debt to GDP ratio this is, this works out of the GDP actually contracting, if you look at it, taking that distortion of extra government inflation pushed into the GDP. Consequently, the idea that there is the backing for central banks is just not true. The ultimate backing isn't there. And we have to tie this in with the credit bubble. Most people don't really understand they're in a credit bubble, but you've only got to look at the other side of credit. Look at debt. Oh, yes, we're in a debt bubble. We all know that. So if we're in a debt bubble, we are in a credit bubble. And that credit bubble is the biggest ever seen in the history of the world. So that is now beginning to topple over. And we see this with stock markets in particular. We see it with cryptos like Bitcoin. We've also got, which is very alarming, I think, a combination of events which we saw in 1929 to 1932. That is to say, the unwinding of the credit bubble of the Roaring Twenties, which was brought about by Benjamin Strong at the Fed, who was if you like, a monetary expansionist. And at the same time, you had the Smoot-Hawley Tariff Act coming in, which increased tariffs by an average of 20%. And some say, there were cases where it was more than that. And what happened? You had other nations, I think something like 67 trading nations at that time responded by increasing their tariffs against the US. So you had this tit-for-tat thing, which suddenly, along with the credit bubble bursting, just threw the whole world into a depression, and particularly America, where some 9,000 banks went bust. This time round, of course, we can't allow banks to go bust. And, they're not small two-branch banks, which, was sort of typical in America in the late 1920s and into the 30s. But, the Fed's going to have a problem. How can it rescue? How can it underwrite the commercial banking system if it is deeply in negative equity and it is becoming apparent to foreign holders of the dollars that they're not getting compensation for the risk of holding those dollars, so they're selling dollars for gold, which is actually what we see at the moment. As far as the Fed is concerned, the only result, if you like, of their trying to rescue the entire financial system in America will be to drive the dollar down. Because part of that is going to be suppression of interest rates, which will be rising. So, this is a situation which I think people are not really aware of. I mean, for a start, they're not really aware. They may just be becoming aware, if you like, that there's a credit bubble bursting. But the vast majority of investors aren't there yet. And I think the second thing is that this sort of comforting thought that, the central banks can always print their way out of trouble and, negative equity doesn't matter in a case of a central bank. And anyway, the government's going to rescue them or whatever, you backstop the whole thing. This, I'm afraid, is not the case. It cannot happen. So we need to understand this. And I think the earlier we understand this, the better for us.